Hello traders! In this video, we'll be discussing crude oil, which is a market that's come up in conversation quite a few times with our group training and masterclass students. So crude oil is obviously a very volatile commodity. It's prone to what most people see as geopolitical risk, macroeconomic risk, and so on. It can affect the underlying movement of many other currencies as well. And we're going to talk about how we can actually make sense of what most people consider to be a wildly unpredictable market using the lens of technical analysis. So as Elliott Wave analysts, we've been looking at this 5-wave impulsive advance in crude oil that kicked off all the way back towards the beginning of May of this year. So we have a clear 5-wave advance, and what we know follows a 5-wave advance is at least a 3-wave corrective pullback. And that's where we use the labels A, B, and C. Now, if you know a thing or two about Elliott, you know that much. What I want to cover is the probable stopping point that I've identified in crude oil and why we can identify these high-value areas for potential trades looking for resumption of the trend. But before we look at that, I just want to cover a very, very important concept. This is perhaps the most important concept that you can ever learn as a wave practitioner or even a market analyst. If you don't want to use Elliott Wave in your day-to-day market analysis, that's perfectly fine. There's a lot of different disciplines and schools of thought out there. But this concept is universal. I just think that Elliott Wave analysts can make the most use of this concept because they have the framework and the tools to do so. And the concept is, how do you juggle the different paths that a market could possibly take? We know that a market can go up, down, or sideways. Now, we have this 5-wave advance, and you can see I've labeled it 1 or A, and we've labeled this 3-wave advance so far as 2 or B. Now, there is one more possibility, however. It's that this 5-wave sequence is completing a larger 3-wave sequence, which we, in Elliott Wave terminology, would call a flat. So a flat is both a bull and a bear trap. Now, in this case, the flat would look like this. It was an up, down, up sequence. So you can see as the market broke support right here, back towards the end of September, everyone would go short the market, and they might have been profitable for a little while, and then they would get stopped out as the market violently reverses higher. And then as the market breaks above resistance here, everyone goes high, and they end up top ticking the market, and the market comes crashing down. That's what I mean by both a bull and a bear trap. So if that's the case, then we should see crude oil accelerate to the downside and take out these prior lows of 63.64. That would be my secondary alternative count. My first count is that this is a 5-wave advance higher in either 1 or A, 2 or B, right? So those are my two primary counts. We have a 5-wave advance that's either wave 1 or wave A, and we have a 3-wave decline that's either wave 2 or wave B. So that leaves me with the following conclusion. I'm looking for another 5-wave advance to go beyond the highs from the end of September. All right, so that would see crude oil break above $95 and head into triple digits per barrel territory, so $100 per barrel plus. Now, here's the really cool thing. That's as far as market analysis gets you. The really cool thing is about how do you make use of this from a trading perspective. Now, there are two options as a trader. You can either buy strength or you can buy weakness. What that means is you're either buying, let's say we have a rally, and then we have a pullback. You can either buy as the market is pulling back, which means I'm buying weakness. I'm trying to catch a falling knife, in other words. Sounds dangerous, but if you know what you're doing, this can be a very profitable strategy. The other option is to buy strength, which means buying the breakout, buying the market after it's showing signs of turning around and heading back in the direction of the larger underlying trend. Now, it's far riskier to buy weakness because you don't have actual confirmation that the trend has changed. So that's a strategy I would recommend using for advanced analysts and advanced traders. Now, there's nothing wrong with mixing both kinds of approaches up all the time. I personally do that. Sometimes I'll buy strength, sometimes I'll buy weakness. It depends on the clarity of the market and how confident I am in my underlying analysis. So what I'm looking for with crude oil is I don't really want to buy weakness because in the back of my mind, I have this possibility that we're just going to go crashing off and take out 63.64 due to this possibly completing the larger flat pattern I'd mentioned earlier. Therefore, I want to buy strength. So what am I looking for? I'm looking for the market to breach a key level to the upside, and taking out that key level is going to give me the confidence that we're headed higher. So the key now is identifying the key level. And that's something that we talk about all the time with our masterclass and group training students. So I'm going to give you a key level here, and I hope this spurs some discussion and you can figure out for yourself why I think this is a key level. But for me, the key level is 83.60. If we break above there, it substantially increases the odds that the corrective decline in oil is over and we can look forward to much higher prices.